Hello everyone, so what we're going to do in this one is talk about options. Now, this is going to be a little bit of a different one. You see, we have Wall Street in the background. We're on the trading floor today. So let me just move this mic. Okay, we're on the trading floor today, and what we're going to do is just talk about options. Here with me, I've got the man, the myth, the legend, Stonks. Stonks is right here. Do you want to say hello? Okay, saying hello, that is all good. So, Stonks is going to help me explain options today. This is going to represent a Bitcoin. This thing here, it's heavy, so you're going to get muscles trading today. This is going to represent an option, and this is going to represent some money, because it's actual money. Let us just go, where am I? So let's go to the slides just real quick, right? So, oh, that is not, yep. Okay, so back in the office, want to go back to the slides. Here we go. So this is what we did in the lesson now, and this is the homework. So I hope you have done the homework. Hold on. This is foreshadowing what's going to happen. Hope you didn't see that. Let's talk about options. Introductions to options and the strategy. So we're going to talk about options first. So we've got two. So what is an option, right? It's just a financial derivative. So you can think about it as a bet, right? So you could either buy Bitcoin or you could either like sit. But what you could do is you could make a bet with your friend and be like, yo, I reckon the price of Bitcoin is going to go up. And if I'm right, you got to pay me $1. And if I'm wrong, I'll pay you $1. So that's what a derivative contract is. It's just a side bet. It's like a side bet. And the underlying is whatever we're betting on. In this case, it's Bitcoin or crypto. Now, there's different types of bets. There's like contracts. There's like, those are the two main ones. There's also like, just stick with that for now. And so there's futures and there's options. We're going to talk about options in this one. We're going to talk about two options, the call option and the put option. Now, just read it out. So a call option is the right to buy the underlying asset, and a put option is the right to sell the underlying asset. So let's go back to Stonks and my boy Stonks here. Stonks, good to see you. Okay, so a call option is like you just have this contract that you the right to buy Bitcoin. So if I do a contract with dude and I own the contract, he has to sell it to me. I have the right to buy it. So let's go to the concrete example. So we've got the Bitcoin, yeah? Got the Bitcoin. So Stonks, he's got the Bitcoin, right? And Stonks, he's selling these options contracts. So he's gonna sell that. Right? And I'm the buyer. So I want you to think about it from the perspective of myself, right? And I've got some money, I got some cash. Okay. Stonks is like, okay, I got some Bitcoin, that's cool. But I want to sell these options, this call options contract. Let's say this is a call option. I'm like, Stonks, I'm going to buy your call option. I can totally buy your call option. So what I'm going to do is Stonks is like $10 for the call option. Cool. So I pay him $10. Yep. Cool. Now I own the call option. Not your options. So what is inside the call option? Well, it's the right. Hello. So unfortunately the video cut off and I recorded 20 minutes. No. So the last thing we did was Stonks had the options and he just sold me the contract. And what's inside the contract, right? So Stonks just collected my $10. What's inside the contract? Well, inside the contract is it's going to say that I will have the option to buy this option later in the future for whatever specified price. So let's say it's the price of Bitcoin right now. Let's say it's 100,000, for example. And so in some future date, let's say a month, Stonks, has to sell it to me for 100,000. But say, for example, the Bitcoin went up to 200,000. And so what's going to happen is if I can buy it at 100,000 at a later date and it's 200,000, I can just sell it immediately back in the market and I would profit the difference, which is 100,000. So as soon as it goes over this so-called price we agreed on, which is called the strike, I will linearly keep making money, right? So let's play the situation out. So a month later, Bitcoin goes up to 200,000 and I say, Stonks, I want to exercise my option. I want to buy the Bitcoin for 100,000. Cool. So Stonks, I'm gonna take this guy's Bitcoin. So I'm gonna take it, and it's my Bitcoin. And this I can just throw away because it's expired, but I've got the Bitcoin. And what I'm gonna do now is I'm just gonna sell all the Bitcoin for 200,000 in the market. And so I would profit 100,000. Easy peasy. Easy peasy. Now, so I'm just gonna show you. So we're on Wall Street. Let's go back to the Oh, that is my recording software. And graceful of me as a filmographer or something. And so okay. So this is called a payoff diagram, right? And so what I've done is I've just simulated like buy a call option, right? And let's say the price is like, I don't know, $10, but one contract is actually 1 cent, right? So what it is like this for like Bitcoin, and then one contract is 0.1000th of so therefore be around 1 cent, yeah, buy the contract. This is the price of the contract if we were trading 1 Bitcoin, but one contract is 1,000th of the Bitcoin. So that's what we pay. Now, let's just say the strike is like that number is there. Now, and so we buy it there, and then if the price of Bitcoin just keeps going up, I'm gonna profit this difference here. This difference. But say for example the price goes down. So in the situation, let's go back to my man Stonks. My man Stonks. So my man Stonks, he had the $10 and he's got the Bitcoin. But now, I have this options contract. Yeah. The price of Bitcoin, let's say in our example, it went down to 50,000. So I would not exercise this options contract, right? Because the Bitcoin is less valuable than the strike price. So I would just walk away, and I have just lost the premium I paid for the option, right? So let's go back to the board thing. So for example, and that's the risk here. So and it shows like different strike prices, the much you're gonna profit. So if Bitcoin goes down, see it's going down here, our risk is capped. Cool, awesome. So let's go back to Stonks. Yep, and now we've done this example from the perspective of Stonks. What I want to do is we've done the example from the perspective of me, Steve. But now let's step into Stonks. Hopefully I was Stonks for a sec. Now think about it from Stonks' perspective. Now imagine, let's go back. I've got my money, I've got my cash. Stonks actually owns the Bitcoin and he's writing all these contracts. Or we say selling the contracts, yeah? Stonks, he has the Bitcoin and he's selling all these contracts, right? Bang, 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 and he profits the $10. Now what's Stonks gonna lose? So say if the price of Bitcoin goes up, Stonks has to sell this Bitcoin at a cheap price, right? So he loses the value difference. He loses what comes to me. So he will actually lose the value difference there. But if it goes down, if the price of Bitcoin goes down, Stonks actually caps his upside. His maximum upside is whatever the premium is, right? So right at the start, he gets his maximum upside. Done. And so a strategy one could use is maybe Stonks, right? He wants to sell many Bitcoins. He wants to sell like different options contracts. So he has like all these different currencies and he's like, here, sell this one, collect $10. Here, sell this one, collect $10. Here, sell this one, collect $10. And if the market doesn't move, right, what's going to happen is he'll just collect all these premium. But if the market does move, he's going to get absolutely destroyed because he has to sell all these Bitcoins to people, right? So you can see how this is going to be a very risky strategy. We are actually going to take the perspective of Stonks. We're going to take the perspective of Stonks and we're going to take the perspective of Stonks and sell a bunch of options. Now, this again is a trading systems course. I'm not telling you what to buy and sell because you'll just like selling naked options like this. We call it selling naked options, right? You just lose money. Like you just lose money. I'm just saying you're gonna lose money. Like if market's sideways, it looks like you're gonna actually make money. But if it just goes up really quick, or if you're selling put options, which is the opposite, like so we're gonna sell put and call options. I'll go through puts in a sec. But if the market just goes up and you're the seller of the call, you're just gonna get destroyed. You're just gonna get destroyed. Okay, let's just go back to the board. Yeah. Now, so this is the perspective of the buyer of the option, so me. Let's just clear this, right? And now let's say we take the perspective of Stonks payoff. Yeah. So it looks like that, right? It's just the opposite. So our maximum upside is capped. Yeah, max profit is that. And as the price of Bitcoin goes up, right? The price here of Bitcoin is increasing. We are just losing money. We are just absolutely getting hammered and destroyed. Cool. So that is, now I just want to go through a put option real quick. So that was selling a call option. A put option is literally the opposite. So now if you buy a put option, right? It's a bit tricky. So if you buy a put option, it's sort of the other way, right? So you profit if the price goes down. You profit if the price goes down. Yeah, but you hedge your risk if the price goes up, you're sort of like hedging, so you don't have a loss there. Now, say we're also going to sell put options, and so yes, so it's literally you flip it in the x-axis. Yeah, the x-axis. So this is our maximum profit here, but if the price goes down, we get absolutely wrecked. We get wrecked on it. Okay, and the strategy at a high level is just going to be, I'll give you a sneak peek, so I'll explain it. So we're going to sell out of the money call and put options. So out of the money just means it's sort of, this is the current price roughly. We're just going to sell, we'll get into why we're doing out of the money, but we're just going to sell out of the money call and put options. And so if we add another, like a call, we sell a call option here. Yep, so now we have two of these. And then the payoff diagram looks like this, right? So if the market doesn't move too much, we get this premium here, like 2 cents. But if it moves in either direction, we're going to get absolutely destroyed. And so what we're doing is, I'm just sort of strategy. I'm just selling like out of money call and put options, and I'm just building up the premium. But notice, we're going to get absolutely wrecked if the market is just going to go in one direction. It's going to drift out, right? So that is how you're going to lose money. And this is actually quite risky. So what we do is you kind of want to these things out. But I want to get into that. This is not like a development course. It's build a trading system. So I just picked a trading strategy, and I'm not going to give you financial advice or what to trade. I'm just explaining stuff so you can sort of, and then the learning is going to be in coding it up. But if you just copy this strategy, you will lose money. You know, market just goes bang or bang, like it goes that way. Okay, so let's stop the video there. Unfortunately, I have to mush the two videos together. Damn it, more editing. It's okay. So homework. Play with the strategy builder and just like make payoff diagrams like these. Just go through it, explore it, like sell out of the money call options. Yeah, and just make some pretty payoff diagrams. Like do each of these. So you want to buy a call option and sell a call option. Buy a put option, sell a put option. Just each of those by themselves. See what the payoff diagram looks like. Just hover your mouse over it. See like how much profit and loss is going on. And then combine the two, right? So maybe sell 3 call options and 3 put options. See what you get. So just have a little explore. Honestly, spend a good like 2 hours on it. To be honest, don't skip this. It's a good exploratory exercise. Okay, I'm gonna stop the video there, and yeah, let's go to. I'm gonna talk about, what am I gonna talk about in the next one? So I've talked about types of options. I'm gonna talk about some Greeks. Okay, I'll see.